You're listening to Business Insights by BPM, a podcast series in which top-of-mind business imperatives are discussed with the brightest minds in the profession, offering world-class solutions. Each episode will bring you conversations with world-class industry leaders from financial services to technology. Subscribe and listen to each episode of Business Insights wherever you get your podcasts. This episode is brought to you by BPM LLP. Our mission is to combine deep knowledge and industry expertise to drive growth for our clients. You can learn more at bpm.com/resources/podcast.
Welcome to our podcast. Tara, it's great to see you again.
You as well.
Couple of quick intros. I am one of the partners at BPM and co-chair of the private capital markets effort here. So I spend most of my time helping companies think about raising capital, selling themselves, and doing other related events. Tara, can you give us a quick intro of yourself?
Happy to, Terry. So I work within TD Cowen in a group called Private Sales and Divestitures. I've been a career investment banker, so doing this for the past 20 years or so, exclusively focused on sell-side M&A as well as capital raising for small private companies within the middle market.
Awesome. Thank you for that. So let's dive in. It's been 10 plus years of quantitative easing, very inexpensive money. There's been a lot of money available in investable funds and in the balance sheets of strategic acquirers and partners. And it feels a little different over the last 9 months or so. Tell us what your experience has been.
Sure. It's definitely been a different market, I would say. 2022 was busy from a private sale mandate perspective. That said, it's been the last half of 2022 as well as early 2023 has been a bit slower. There's been quite a bit of noise in the market due to a variety of factors, not the least of which has been some of the smaller regional banking collapses have certainly impacted smaller regional lending for private market participants. That certainly has, I think, constrained some private sales over the last 6 to 12 months. You know, what's interesting as well, you see a market where there have been fewer IPOs in the 18 months beginning January 2022 than for any single year since 2016. I think we're seeing some of that start to loosen a little bit, particularly this week. You've seen some of the bigger names coming out with potential in IPO processes, including Instacart. Things are starting to pick back up.
Yeah, we're seeing something very similar. Piggybacking on that, one of the things that is very central to most conversations I have these days is, well, should I do something now? And for some people, that their runway just doesn't allow them to do anything else. And so the conversation of a debt or equity event has to be there. But maybe talk us through, is now the right time?
Absolutely. I think as you think about timing, often it depends really on the specific situation and a particular potential seller's objectives and what they're looking to do. That said, I would say what we're seeing in terms of the market right now, high quality assets are getting a ton of attention. There's something like $1.2 trillion of dry powder among private equity right now, equity only. And I think if you look across the strategic buyer landscape, I would say people are doing aggressive things because there's a lot of cash to put to work. The S&P is sitting on $1.2 trillion of cash to put to work in things like M&A processes and are being thoughtful, I think, around where they're spending their money and where they're looking to invest. We've seen strategics getting really aggressive. Funny, just earlier this week, and I would say on the whole, it's actually almost easier to sell your company right now, given the scarcity of assets that are out there and the number of potential buyers than 6 to 12 months ago even.
Yeah, it's a good point. And I think we'll see things maybe normalize towards the latter part of this year and Q1 next year from a volume of deal perspective. So as a follow-up, what can people do to get attention? My typical advice is that now more than ever, our clients have got to be more precise, more cogent, more succinct in their storytelling, and really be able to evidence their success, whatever that may be, growth, the unit economics and benchmarks behind the business.
It's a good question, Terry. I think there are a few things that set companies apart in terms of approaching the market. And part of our job as advisors is to really help people walk through that process. And a lot of the front end work, typically buyers aren't seeing that front end work, right? Where we spend months with a company trying to think through ensuring that we have thoughtful and credible projections, articulated growth story, as well as just ensuring that the business is ready to embark on a sale process. There are certain things that we recommend our clients do as part of that process of getting ready to go to market. And one of those things is really scrubbing the financials, right? Working with firms like yours to ensure that we really understand what is the true adjusted EBITDA of this business. So I think the more prep you can do at the front end of really understanding normalized earnings and scrubbing the financials really makes for a much easier process. It helps position the business in terms of the outreach process and ensuring that it holds up to scrutiny of different buyers.
Yeah, absolutely. I feel like buyers have always been persnickety, and I believe there's an added layer of sincere concern. When's the shoe going to drop? And one of the things that we've done as well is begun to build bottoms-up 5-year projections that tell a cogent story of growth that satisfies the sort of accountability apparatus on the other end.
And Terry, as part of that, in terms of the projections, I think one of the things that we counsel folks on, it really needs to be aggressive yet credible in terms of what you're putting forth in a process. So you don't want to compromise your credibility by putting pie in the sky projections because you want to show excessive growth, right?
100% agree. So let's dig into the opportunity a little bit more. So I mentioned earlier, I do believe, and we're seeing some indications that certain kinds of companies will be really rewarded for being both present and being able to evidence themselves in a market like today. Are there sectors, are there other sort of commercial habits that you're finding really stand out today and satisfy what investors or strategics are looking for?
It's a good question. Obviously, it depends on the specific private equity fund and what their mandate. And we work with a lot of financial sponsors, and obviously many focus on different markets. But I would say most broadly right now, folks are interested in sectors that have either recurring earnings of some kind, right? The outlook for the next 6 to 12 to 18 months is a little bit certain as inflation has been moderating and interest rates are rising. I think we're seeing some challenges in terms of consumer spending, and that's starting to slow a bit.
Even an AI or SaaS type of business, or how well do those track what we're talking about versus differ in your mind?
I think the question really depends on the market opportunity for those types of businesses. What is the potential path towards growth? We tend to work with private equity firms that are more focused on profitable businesses. And I will say, just generally speaking, it's been more challenging for businesses that are still not at the break-even level to raise capital in this environment.
I suppose I'd say our view here is that if you are an earlier stage company painting a credible picture towards path of profitability, and that pro forma, that projection becomes, and its credibility, I think, becomes even more important. That's really mostly what you have to stand on. And maybe if you're 3 years old, you've got some patterns of customer repeat buy and multi-year contracts that have been tested. So behind every business is the person, is people. Love to talk about what I just call internally the pathology of a deal. These transactions are hard in their best of cases, and they take a certain level of resolve and just practical commitment of time. Maybe any best thinking on just people getting through a raise or a sale personally and emotionally. What kinds of things are you doing to help people demystify the process?
I tell our clients at the outset of every process that there are going to be highs and lows, and it's going to be a roller coaster of emotions. So educating them and getting folks ready includes walking them through that timeline, what it looks like. It can be 6 to 9 months at the earliest, and you can take as much time as you need to prepare. But I think spending time getting ready to go to market, being thoughtful about projections, and doing as much upfront work as possible is really important to ensuring success in a process.
Yeah, I couldn't agree more. I think that for something that should be as simple as a raise with a follow-on investor, things are going to take longer. They're going to be harder. They're going to ask more questions. The accountability apparatus, either a board or an investment committee or someone similar, is going to ask more questions of the people that you're speaking to as an entrepreneur. What are the magic words that might work to get an entrepreneur to listen to you or I about getting ready appropriately?
I think it depends on the situation, but but often when we have inbound inquiries from sellers that are in dialogue with what we call a preemptive buyer, so somebody who's reached out to them and put something on the table. So typically when we engage with a party that has been speaking to a potential preemptive buyer, which is what we'd characterize as somebody that's reached out to a seller and has put something on the table, whether it be a term sheet for a capital raise or an indication of interest or a letter of intent declaring some kind of value that they're willing to pay for the business. Typically, we would come in and counsel our potential client that there's still a lot of work to be done to get to the finish line. There's still quite a bit of diligence that typically needs to be undertaken by the potential buyer, whether that be in terms of valuation or just in terms of the type of buyer that you're going to engage with or capital structure or whatever it might be. But we want to ensure that there are alternatives. I think having that conversation before
committing to one particular party is important to have.
It's so important. And I think one of the things that drives us on each one of these deals is having our client only have to do it once and organize the process and really try to force the targets to participate in something that has them relatively into the shoot at the same time and speaking to the client at the same time. The strategic fit is such an important part of these deals, right? There's structure, there's valuation, there's the way the money changes hands, but I think the strategic fit and being able to meet different people that act differently and have a different strategy of their own is a really critical process for our clients. I know we've talked about the process being curated to help support that. And obviously, if we do our job, we've thought of 75 or 85% of that. What are some of the other secrets to success and preparedness as it relates specifically to diligence?
It's a good question. When we work with our sellers, we try to prepare them well for the onslaught of diligence, if you will. But I find no matter how we explain it, I think often parties are still surprised at the magnitude of diligence that takes place in a sell-side transaction. And I think the more that you can front end load that, make it as user-friendly as possible, as well organized as possible, and get ahead of it, it really helps answer those questions before they're asked.
Makes total sense. So I'm hearing us say that whether you're a startup emerging company or a 40-year-old startup, you've got to get ready. We talked about companies with recurring revenue streams or a high degree of reoccurrence, maybe business to business or enterprise focused are going to get rewarded and get attention in the process.
I would say start early is the first one. I think engage with advisors long before you actually think that you want to go to market and raise capital and or go through a sale event. Because the sooner you engage the right people in terms of financials and tax and working with an investment banker, the sooner you can do that, the better in the process. So start early and it will give you ample time to prepare and make sure that you're looking ahead towards what's next and doing the right things in the meantime in order to get yourself ready. I'd say that's number one. I think number two is surround yourself with advisors that you like to work with. You're going to be in the trenches with these folks for many months, and it's a stressful and strenuous process at the very best. And I would say the third thing is when you're making decisions about your business, we always counsel our sellers, do what's best for the business and not necessarily what's best for the process on a go-forward basis. And don't necessarily make decisions based upon selling it in 6, 9, 12 months. Do what's best for your business. And that ultimately, I think, will accrue to the benefit of the sale process.
Could not agree more. Tara Smith, thank you very much.
Thanks, Terry. It was great to chat.
Likewise.
We hope you enjoyed this episode of Business Insights by BPM. You'll find links to any resources mentioned in today's show notes. And if you'd like to learn more, visit bpm.com/resources/podcast. Thank you for listening. Be sure to subscribe for updates on future episodes. This episode is brought to you by BPM LLP. Our mission is to combine deep knowledge and industry expertise to drive growth for our clients. You can learn more at bpm.com/resources/podcast.